All right, let's dive into the second quarter 2025 earnings for TPG RE Finance Trust. You know them by the ticker TRTX. The commercial real estate market has been, well, let's just say it's been tricky. You've got banks taking a step back, you've got serious headwinds in some areas. So the real question is, how did a company like TRTX manage to not just get by, but actually crush it? Well, the answer, and we're going to break this all down, really comes down to this incredible dual strategy. They were playing aggressive offense and rock-solid defense at the exact same time. It was honestly a masterclass in how to handle this kind of market. Okay, so here's how we're going to tackle this. We'll start with a quick snapshot of the Q2 numbers. Then we'll get into the weeds of that deployment meets de-risking strategy. After that, we'll cover what management is seeing out there, and then we'll get to our segment, The Next Call, where we give you our rating, before we wrap it all up with the key takeaways. First things first, let's talk results. And look, there's no two ways about it. This was a really clean, decisive beat. Let's start with the headline number that everyone was watching: distributable earnings. They hit 24 cents per share. Now, that's absolutely critical because it means they perfectly covered their 24-cent dividend, which is, a huge deal for income investors. And it gets better. Not only did they cover that dividend, but that 24-cent figure came in a solid 9% ahead of what Wall Street was expecting. That's the kind of surprise that really makes people sit up and take notice. So, did the market notice? Oh, you bet it did. The stock popped on the news, finishing the day up 3.7%, and it did so on way higher trading volume than usual. That's about as clear a vote of confidence as you can get. So let's just put it all together here. You've got that big 9% beat on earnings, they edged out revenue expectations, but this might be the most important detail. Their book value per share actually went up. Just by a penny, sure, but in a market where so many others are seeing their book value shrink, that stability is a massive green flag. Okay, so the numbers look great, but how did they do it? This brings us right to the core of their game plan this quarter, this brilliant idea of deploying a ton of capital while at the same time cleaning up and de-risking the balance sheet. And you can see that strategy right here. On offense, they went on a tear, originating almost $700 million in new loans. But on defense, they were just as busy, selling off a couple of old office properties for a nice gain and buying back their own stock on the cheap, which, by the way, added a cool 8 cents to their book value. It was a perfect 1-2 punch. And that defensive move was huge. By selling those assets, their exposure to office REO, that's property they actually own, usually after a foreclosure, well, it shrank to just 1% of their total assets. Think about that. They basically neutralized one of the biggest risks plaguing the entire sector. Now, let's flip back to the offense. All that new money they put to work, where did it go? Almost all of it went into two areas, multifamily and industrial. These are the sectors that management believes are the most durable, and boy, are they putting their money where their mouth is. So we've covered the what. Now, let's get into the why. What is management seeing out there in the market that gives them the confidence to be so aggressive, yet so careful at the same time? Well, CEO Doug Bouquard really nailed it on the earnings call. He said this market has given them an excellent window of opportunity. And what he means by that is pretty simple. As traditional banks keep pulling back, it creates this vacuum, and a lender like TRTX can step right in and make really good loans on really good terms. So what's the game plan from here? It's pretty straightforward. Keep taking advantage of that bank pullback. Keep focusing on multifamily and industrial. And by the way, they've already got a pipeline with over $200 million in new deals ready to go. And here's the kicker. Through all of this, their entire existing loan book is still 100% performing. That's a really powerful combo of stability and growth. All right, so that's the story from the company. Now it's our turn. In our segment, The Next Call, we're going to look ahead and give you our take, our thesis, and our rating based on everything we just heard. And our entire thesis really boils down to this one powerful idea, the discount to book value. Right now, the company stock is trading for about 25% less than what its assets are actually worth on paper. And you just have to ask yourself, why is that gap so big when the loan portfolio is performing perfectly? We think that gap is going to close. And here's our logic, step by step. 1. A 25% discount just feels way too steep for a company that's executing this well. 2. There are obvious catalysts on the horizon that can shrink that discount, that huge pipeline, more asset sales, and more of those smart buybacks. 3. The fundamentals are just rock solid. All of that leads us to our final verdict, an outperform rating. When you put it all together, the clear growth, the smart de-risking, and that big valuation discount, it just creates a really compelling setup for the stock.
Okay, so before we go, let's just boil all this down into the most important points you need to take away from TRTX's fantastic quarter.
First, this was a super clean beat, plain and simple, and it was all about great execution. Second, that deployment and de-risking strategy isn't just a buzzword, it's absolutely working. Third, management is playing chess while others are playing checkers, capitalizing on the pullback from banks. And finally, it all comes back to that discount to book value. It just seems like a potential opportunity, especially when the fundamentals are this strong. And as always, just a quick reminder, this is not financial advice. All of our analysis here is for informational purposes only.